A very good day to the judges of this specific competition and the reviewer for this competition. Specifically for the case study of decoding transfer pricing dynamics in Malaysia 3.0. Now, my name is Ahmad Raziq, followed by other four group members such as Muhammad Irfan, Shaarvesh, Ahmad Adib, and Ryan. Now, let me explain the case briefly. In the case introduction, Orange Gears is a German automotive multinational that expanded into Malaysia in 2016. The Malaysian entity operates as a low-risk contract manufacturer, meaning it doesn't own any designs. It simply follows instruction from Germany to produce transmission components. For this service, it is a paid 5% markup on its cost. This arrangement was stable for 8 years until a 2024 Inland Revenue Board Malaysia audit. The tax authority is now questioning if this 5% rate is still arm's length, sparking a major dispute over how much profit should actually stay here in Malaysia versus being sent back to the German parent company. Now let us dive into the specific issue. Issue 1, lack of co-current documentation. The first major issue is the lack of co-current documentation, where transfer pricing is not a set and forget. The arm's length principle requires that prices reflect what independent parties would do today, not a decade ago. By failing to update their benchmarking studies since 2016, Orion Malaysia cannot prove that 5% is still a market reflective rate in 2024. In the eyes of IRBM, this lack of updated data and makes the 5% figure appear unrelated rather than market-based. Moving on to the second issue in regards to functional and risk misalignment. The second issue involves the FAR analysis. FAR means functions, assets, and risk. Orion Malaysia has improved its efficiency and volume. Still, its profit margin remains capped. Under a cost-plus model, higher efficiency actually reduce the cost base, which can lead to lower absolute profit. This is a major point of contention for the IRBM. Furthermore, we must ask, are the IRBM's independent companies truly comparable? If those companies bear entrepreneurial risk like finding customers or developing tech, comparing them to a low-risk entity like Orion Malaysia is like comparing apples to oranges. Moving on to the next presenter.
Okay, thank you, Raziq. So moving on to the question two. See the first part of the question two, where we need to address whether the 5% cost plus markup currently applied by the Orion Malaysia satisfies the arm's length principles. Okay, after we review the current regulatory landscape based on our assessments, we can say that the 5% markup is unlikely to be considered as a arm's length under current Malaysian tax regulation. First, let's look at the legal framework under Section 140A, Subsection 2 of the Income Tax Act 1967 and the Malaysian Transfer Pricing Guideline. They say that the transaction between companies must mirror what independent parties would charge. Essentially, Orion Malaysia profits need to reflect what a similar low-risk manufacturer will earn in the open market today. A statistic of a 5% rate may not accurately reflect the current market value of these services. Okay, moving on to the second issue, which is the 5% markup was remained unchanged since 2016. According to the Malaysian Transfer Pricing Guideline, the transfer pricing documentation should be updated annually to reflect the current market condition. A markup set nearly a decade ago cannot account for today's economic change, such as the rising labor costs, the utility expenses in Malaysia. What was fair in 2016 is likely insufficient in 2026. Finally, we also must consider the arm's length profit range. In the transfer pricing guideline, saying that the range should fall between 37.5 to 62.5 percentile of the comparable companies. Because the Orion market has been not adjusted for inflation or industry trends, it's highly likely that the corporation price fall below the 37.5 percentile. So in summary, to maintain the status quo of the company at the tax adjustment and the penalties, we must re-evaluate this markup to align the latest national transfer pricing guideline standards. So the next part on the how to assess this will be presented by the next presenter.
Thank you, Adib. Now I will explain how the 5% markup is assessed. First, we begin with a functional and comparability analysis. Orion Malaysia operates as a low-risk contract manufacturer, meaning it performs routine manufacturing activities without owning intellectual property or bearing significant risk. Therefore, it should be only compared with companies that have similar function for function, assets, and risk profile. Next, we select the most appropriate transfer pricing method, which in this case is the transactional net margin method, and also cost plus method is appropriate. This method is suitable because it evaluates profit margin and is commonly used for routine manufacturing entities. After that, a benchmarking analysis is carried out. This involves by comparing Orion Malaysia 5% markup with the profit margin earned by independent companies. The comparables used must be reliable and preferably based on Malaysian companies to reflect similar economic condition. Next, we apply the arm's length range, which under Malaysia Transfer Pricing Rules 2023 is between the 37.5 and 62.5 percentile. If the 5% markup falls within this range, it is acceptable. However, if it falls below the range, an adjustment to the median is required. In this case, if the benchmarking result shows that the comparable companies earn higher margin, this would indicate that the 5% markup is below to the acceptable range. Finally, it is important to use updated data as market condition changes over time. Since Orion Malaysia markup has not been revised in 2016, it may no longer reflect the current market condition. In conclusion, based on the assessment process, if the 5% markup falls below the arm's length range and is not supported by updated benchmarking, it would not be considered as an arm's length. Thank you.
I'll be carrying with the next part. Now, let's look at the so what if Orion Malaysia decides to ignore this finding and stick with our current 5% markup. The consequences aren't just theoretical, they are legally and financially concrete under current Malaysian law. First, under Section 140A, the IRBM has the power to simply rewrite our profit. If they determine our 5% markup doesn't reflect the arm's length principle, they will substitute it with a higher industry standard, say 10% or 12%. The impact, we won't just pay tax on future earnings. This is retrospective. The IRBM can look back over the last 7 years, issuing an additional tax assessment on every dollar of missing profit. This could lead to a massive unbudgeted cash flow that hits our bottom line immediately. Second, next. Second, we face severe penalties under Section 113B for documentation non-compliance. If we can't provide robust, contemporaneous transfer pricing documentation to defend our 5% rate, we are essentially defenseless. The reality, we would face a fine of RM 20,000 to 100,000 per year of assessment. Under the latest framework, we have only 14 days to submit this TPD. Once requested, failure is automatic. Most soberingly, This section carries criminal liability. Company officers could face up to 6 months of imprisonment for these failures. Third, let's talk about the surcharge. Since 2021, Malaysia introduced a specific transfer pricing surcharge under Section 140A bracket 3C. Even if Oraya Malaysia is currently in a tax loss position and doesn't owe corporate tax, the IRBM can still impose a surcharge of up to 5% on the total amount of the transfer pricing adjustment itself. This is a dry cost, money straight out of pocket that cannot be offset by previous losses. It is a penalty for the act of mispricing, regardless of our final tax bill. Next. Finally, there is the high risk stigma. By ignoring the audit finding, Oraya Malaysia marks itself as a high risk taxpayer in the IRBM system. This triggers much more frequent field audits and focus us into the tax corporate governance framework reviews. This isn't just paperwork, it consumes significant management time and expensive legal resources. We will be under a microscope for years to come, making every future transaction more difficult to clear. In short, maintaining the 5% markup isn't just a pricing choice. It's a decision to accept multi-million ringgit fines, potential jail time for officers, and constant legal battle. That's all from my part.
All right. Thank you, Ryan. Moving on, I'll be presenting about the steps should be taken by Orient DS Limited to address this transfer pricing issue. The first step is they should perform a revised benchmarking analysis, whereby assessing Orient Malaysia with independent contract manufacturers who carry out the similar duties and take on the risk that is comparable. And the best approach for this benchmarking analysis is to do the transactional net margin method. This is important because without benchmarking, Orient cannot prove that its 5% markup reflects with the market conditions. The tax authority may compare the related party transaction with independent companies. So if Orient does not do this particular analysis, the Inland Revenue Board of Malaysia may assume that the price is too low and they may infer to adjust the income. And for that case, Orient should determine an arm's length range of profit margins, such as 6 to 9%, following the current nation transfer pricing regulations. Secondly, the amendment of transfer pricing guidelines, whereby since the 5% markup hasn't been changed since 2016, the business has to update its pricing strategy to a current transfer pricing guidelines. This is important because profit levels actually must match the level of function and risk. And since Orient Malaysia is a low risk contract manufacturer, it should earn a routine return, where the return should be justified. And without the proper analysis, Orient couldn't explain why it deserves a lower margin. All right, next. All right, for the third step is to establish appropriate transfer pricing documents, where Orient is required by the Malaysian transfer pricing guidelines to keep the contemporary records such as the functional analysis, which also includes the risk, assets, and also the function. And this record also assists transactions to be conducted at arm's length. The reason is it's important because during a tax audit, IRBM especially relies heavily on the documentation. If Orient cannot provide proper documentation, even a reasonable price may be rejected. In addition, the failure to maintain this documentation can lead to further penalties and surcharge. So, in that case, this is also they could also use this document to avoid further penalty charges. And last but not least is the fourth step, which is they should consider the advanced pricing arrangement with IRBM. where Orient may submit an application to IRBM for an advanced pricing arrangement. And this permits an agreement on transfer pricing strategy, which with a suitable profit margin. Okay, all right. This step is very important because this advanced pricing arrangement they are important because instead of facing repeated audits and adjustments, Orient can agree in advance with IRBM on the correct pricing method and margin, which they could reduce the future tax risk. And also, it reduces the future disagreements and offers assurance in the long run for the company. So that's all from me, and thank you very much for listening.